guys, welcome back to Introduction to Accounting. My name is Megan and today we're talking about property, plant and equipment. To see more of these videos, hit the subscribe button below and give it a big thumbs up if you liked it. So first off, what is PPE? PPE is a tangible item that is used in the production of goods or services, for rental to others or for administrative purposes, and is to be expected to be used during more than one period. So let's break it down. It needs to be a tangible item. So if I can't touch it, it can't be PPE. So for example, your car could be a part of PPE, but your computer software, like your Windows software, that wouldn't be part of PPE because you can't touch it. You also need to use your property, plant and equipment to make goods or services. So if you're actually selling the factory, it wouldn't count as PPE. We can also use it to rent to other people or for admin purposes, for example, an office building. And remember, we need to keep it for more than 12 months. So if we use it for less than 12 months, it might not be classified as PPE. So now that we know what PPE is, we can recognize PPE as a non-current asset if it is probable that future economic benefits associated with the asset will flow to the entity and the cost of the item can be measured reliably. Both conditions need to be met before we can recognize the asset. So, if economic benefits flow away from the entity, we can't recognize the asset. Future economic benefits could be in many forms, for example, the rights to something or money coming into the business. Property, plant and equipment must be measured at cost price. Our cost price includes the following things: the purchase price, any import duties, and any non-refundable purchase tax. We will then subtract any trade discounts or any rebates that we were given. We'll also add any directly attributable costs that we had to have in order to bring the asset to where and how we need it for use. We will also add the initial estimate of any dismantling and removal costs in terms of IS 37. Let's look at what a directly attributable cost is. These costs are only incurred because of the acquisition or construction of the item of PPE. Therefore, if this cost has nothing to do with that specific asset, we cannot add it to the cost price. Some examples are employee benefits incurred as a result of acquiring the item of PPE in terms of IS 19. The cost of site preparation is also part of this. Delivery and handling costs, installation and assembly too. We'll also add the testing costs of the item of PPE, and we then subtract any proceeds from any sample sales that we had during testing. We'll also add the professional fees of lawyers, engineers, or other experts. Please keep in mind that we cannot add any professional fees for these people if they are already part of our business. They need to be hired purely because of the acquisition or construction of the asset. Only then can we add them to our cost price. And of course, not every cost that we incur can be part of the cost price. The following items are not part of the cost price of PPE: the opening of a new facility, bringing a new product or service into our business, as well as the cost of advertising and promoting. When we open a new location and we train those staff, we also can't add that to the cost price, and any administration and other general overhead costs. So there are three ways in which we can acquire PPE. The first way is to buy it cash, in which we would debit the asset account and credit the bank account, because our cash drops and we buy an asset. We can also buy it on credit, where we would debit the asset account and credit creditors' control, being a liability. We can also purchase or acquire an asset via an exchange transaction. Please note that the exchange transaction must have commercial substance. An exchange transaction is always measured at fair value, unless the exchange transaction lacks commercial substance or the fair value of both assets can be reliably measured. The acquired item is measured at fair value even if an entity cannot immediately de-recognize the asset that they gave up. If the item that we've acquired is not measured at fair value, the cost price is then equal to the carrying value of the asset that we gave up. So now that you've acquired your item of PPE, there are a few things that you need to consider in terms of your subsequent measurement. The first thing you need to do is you need to choose a model, either being the cost price model or the revaluation model. You then need to depreciate your asset every 12 months, as well as any impairment losses in terms of IAS 36. Should you choose the revaluation model, you will either get a revaluation surplus or a revaluation deficit. As I mentioned before, there are two models for subsequent measurement. The first one being the cost model. In the cost model, your carrying value is equal to your cost price minus your accumulated depreciation minus any impairment losses. If you choose the revaluation model, your carrying value at the end of the year is equal to the revalued amount. The revalued amount is the fair value minus any depreciation minus any impairment losses for the year. Let's look at depreciation. We depreciate every 12 months or on the date of disposal. We calculate depreciation on the depreciable amount, which is the cost price minus any residual value. There are two main depreciation methods, the first one being the cost price or the fixed installment method, where depreciation is the depreciable amount times the depreciation rate as a percentage times the months over 12. When we talk about the months over 12, we're talking about the months between the purchase date and year end, should it be in the year that we've purchased it. Any subsequent year, X will always be 12. You can also look at it as X being the number of months between the last depreciation and year end. So for example, if I bought a vehicle on the 1st of March 2009 and my year end is the 30th of June, I've got March, April, May, and June to depreciate, so X will be 4 months. Looking at the second method, we call it the diminishing balance method, or the book value method, or the reducing balance method, where the calculation is depreciation is equal to carrying value times the percentage times X over 12, where X is the months. Always remember that carrying value is equal to your depreciable amount minus any accumulated depreciation. So now that you've done all your calculations, you're required to disclose all the information for the users of the financial statements. We do this in a note which takes the form of a reconciliation. We compare the cost price, carrying value, and accumulated depreciation at the beginning of the year to that at the end of the year. We also group our assets into their classes, for example, land together, buildings together, and vehicles together, each in their own column. We also include any revaluation details, including whether or not the assessor was independent, as well as the date of revaluation. When we use the revaluation model, you must include a calculation for the carrying amount using the cost price method. All of this will be done at the bottom of the note as a narrative. And lastly, just an example of what the note could look like. As you can see, vehicles and equipment each have their own column. The carrying value at the beginning starts at the top, which is followed by cost price minus accumulation in a calculation block. You then subtract the one from the other and put the answer on top. The next section is the movement section, which includes additions, disposals, impairment losses, depreciation, and the revaluation surplus or deficit. At the end, we've got carrying value, cost price, and accumulated depreciation again. As you can see in the total column, I've got a little yellow block that says SFP. The amount that you get in the total column for carrying value is the amount that goes onto the face of the statement of financial position under non-current assets in the line tangible assets. That's it, guys. Check back for more videos soon.